Europe's EV surge puts charging grids and policy under test. Europe's battery electric vehicle market recorded a strong first half of 2026, with registrations exceeding 1.2 million across 17 tracked markets. June was a standout month. A total of 275,160 new battery electric vehicles were registered, representing a 39.5% increase from June 2025, according to a bulletin from New Automotive, Fear Automotive, and E-Mobility Europe. BEVs accounted for 25.6% of new registrations across the markets included in the report. The estimated share across the European Union was slightly higher at 27.4%. The figures point to a broader shift in the European automotive market. Electric vehicle adoption is no longer being driven solely by a small group of established markets. Growth is spreading into countries where BEV penetration has historically been lower, bringing new commercial opportunities alongside infrastructure and policy challenges. Record BEV growth spreads across European markets. Registrations reached 1,241,916 during the first 6 months of 2026, up from 928,800 in the same period of 2025. Italy recorded the fastest year-over-year growth, with registrations increasing by 97.9%. France followed with growth of 61.3%, while Germany rose 48.6% and Spain increased 31%. Several countries also delivered their strongest monthly results to date in June. France registered 55,851 battery electric vehicles, giving BEVs a 29.6% share of its new car market. Spain recorded 14,559 registrations and an 11.3% market share. Slovenia and Czechia set records for both monthly volumes and BEV penetration. Belgium, Denmark, Portugal, and Finland reported their highest monthly BEV registration totals, although not all reached record market shares. This wider geographic spread matters for manufacturers, energy providers, and infrastructure operators. It suggests that investment decisions can no longer be based primarily on mature Northern European EV markets. Charging demand, fleet electrification, and grid planning are becoming relevant across a much larger part of the region. Some European countries are already reporting adoption rates above China's June BEV market share of 42.8%. Norway remained the regional leader, with electric vehicles representing 96.5% of new registrations. Denmark reached 79.1%, followed by Ireland at 51.2%, Finland at 48.9%, and the Netherlands at 43.5%. These percentages should be viewed in context. National vehicle markets differ significantly in size, tax structures, incentive programs, and consumer behavior. China continues to operate at a much larger scale in terms of EV production, battery manufacturing, and total vehicle sales. Europe's rate of growth was nevertheless stronger in June. BEV registrations across the tracked European markets increased by almost 40% year over year, compared with reported growth of around 6% in China's domestic BEV registrations. For automakers, the expansion brings both demand and competitive pressure. Manufacturers must increase the availability of electric models while managing vehicle pricing, production costs, supply chain exposure, and uncertainty around national incentive schemes. Greater new vehicle supply may also support the development of Europe's used EV market. As more electric cars enter company fleets and private ownership, a larger number should eventually become available at lower price points. That could make electric vehicles accessible to a younger and more cost-conscious group of buyers, including consumers who are interested in switching but remain priced out of the new car market. Charging, grid capacity, and policy become the next test. Vehicle registrations are moving quickly, but the systems supporting them will need to keep pace. Charging capacity must expand across residential developments, workplaces, retail sites, commercial properties, and major transport corridors. At the same time, utilities and grid operators will need to prepare for changes in electricity demand as electric vehicle ownership becomes more widespread. This creates a larger addressable market for charging operators, energy companies, property owners, fleet managers, and software providers. Businesses able to connect vehicle charging with renewable generation, battery storage, and flexible electricity tariffs may be particularly well placed. Smart charging platforms can help shift demand away from peak periods, while on-site generation and storage can reduce pressure on local networks. Fleet electrification is another potential growth area. As more vehicle models become available and total operating costs improve, logistics companies, service providers, and corporate fleets may have a stronger case for replacing petrol and diesel vehicles. However, charging access remains uneven. Drivers without private parking may depend on public or workplace infrastructure, making location, reliability, and pricing central to wider adoption. Policy consistency will also influence the direction of the market. Changes to purchase incentives, emissions requirements, or infrastructure rules can affect consumer confidence and delay investment decisions. Automakers and infrastructure providers require clear timelines to plan model launches, manufacturing capacity, charging projects, and supply chain commitments. Sudden regulatory changes risk disrupting those plans, particularly in markets where EV demand remains closely linked to tax treatment or subsidies. Europe's June registration figures show that battery electric vehicles are gaining ground across a broader range of markets. They do not, however, guarantee that the current pace will continue.